Hi, this is Professor Karen Lin. Welcome back. In this video, I'm going to explain notes payable and contingent liability. Let's get started. Let's first talk about notes payable. What is a note? A note is basically, in essence, a written contract of borrowing. On the note, it would typically specify who the lender is. In this example, is Bank Zone. And the principal of the loan is $10,000. The interest rate is an annual interest rate of 8%. And also the maturity date is June 30th, 2008. So to the lender, interest is a revenue. To the borrower, interest is an expense. How do we calculate interest? Interest equals to the principal multiplied by annual interest rate multiplied by the number of months divided by 12 months. Well, you will see, why do I need to do the multiplying number of months divided by 12 months? Now I'll show you in an example. Let's assume that on November the 1st, a company with a December 31st fiscal year end borrows $100,000 cash for 1 year. So this loan is for a year. The annual interest rate is 12%. The interest is paid on April 30th and October 31st of the next year. And the principal is repayable at the maturity date, October 31st of the next year. So if you look at the timeline, the borrowing date is November the 1st, lasts for a year, right, to this October 31st of next year. And this is very common, that a long-term debt or the notes payable would be setting the interest date of every 6 months. So April 30th is basically the midpoint of a year duration. Now the complication is that December 31st is the fiscal year end. Now this is the problem, because remember, when you prepare a balance sheet or income statement, you always look at what happened at the end of this year. For example, when you prepare the balance sheet, you always ask yourself, as of December 31st, how much loan does the company have? How much interest payables does the company have? So on November 1st, when the loan is just borrowed, the company recorded the note as debiting cash, crediting notes payable for $100,000. This is pretty straightforward. When it comes to December 31st, on this date, we need to prepare the income statement and the balance sheet. So on December 31st, the company would have incurred 2 months of interest because we have used the loan from November the 1st to December 31st, which is a 2 months time. To calculate the interest, because again, remember matching principle, if we use the loan, the interest associated with using the loan should be matching with the revenue that's generating during the period. So if we use the loan for 2 months during this period, we need to match the revenue generated during this period with the cost, which is the use of the loan, to that revenue. So matching the cost of using the loan to the revenue is the idea. So we want to calculate the 2 months of using the loan, which is using the principal $10,000 multiplied by the 12% annual interest rate, and also multiply by the 2 months over 12 months. Because if you think about the 100,000 multiplied by the 12%, right? If you think about this part of the equation or of the formula, this part is the whole year's interest. But we only been using 2 months out of 12 months of a year. So that's why we need to multiply by 2 divided by 12. That gives us 2,000. So the 2,000 is basically related to using the loan during November 1st to December 31st. we will be debiting interest expense $2,000, crediting interest payable $2,000. Now, in the same vein, when you think about April, on April 30th, here, the firm has to pay the interest, right? The firm has to pay interest. How much would the firm pay for interest? That means the company would pay $10,000 multiplied by 12%, multiplied by half a year, 6 months divided by 12 months, which is $6,000 cash. The firm would pay $6,000 cash on April the 30th, which covers half year of using the loan. However, we have already recognized expenses on December 31st for the $2,000. So from December 31st to April 30th, during this period of time, the company only using 4 months of the loan. So the expenses for this period of time is actually $4,000 expenses. Okay, and then if you look at the entry would show that the company would accrue another $4,000 interest expense. As I mentioned, there's only $4,000 interest expense from December 31st to April 30th. So $4,000 interest expense and another $4,000 interest payable. So if you look at the interest payable account, right? If you look at the interest payable account, we already accrued $2,000 on December 31st, and then we accrued another $4,000 in April. So altogether, we have $6,000 interest payable, which is exactly what we are paying back on April the 30th. So on April the 30th, we would debit interest payable $6,000 because we pay back in cash. All right. So, and then we credit cash because we paid cash. That would cancel our interest payable out. So that is how we calculate the interest associated with notes payable. All right. Let's take a look at something called contingent liabilities. By its name, we understand contingent liability is a type of liabilities that is conditional on something. So contingent means conditional on a certain condition. So it is a potential liability that has arisen as a result of a past event. It is not a definitive liability until some future event occurs. An example of this would be lawsuit. If a company is unfortunately being sued by a customer. Now, until the court rules, the company does not know how much or whether the company will pay the customer. But there is a likelihood the company will have to pay the customer. That's why it's called contingent liability. First, the company has obligation to pay if the company lost the lawsuit. Second, the amount or the outcome of the liability depending on the future event, which is the court ruling. In this example, or under such circumstances, how would the accountants react in the accounting system? Now, the GAAP, or the generally accepted accounting principles, has some guidance on those type of events. Basically, how to record such an event depends on two things. One, how likely is the outcome, or is the negative outcome going to occur? Two, can we estimate the amounts of the outcome at this point when we prepare the balance sheet? So if the amount can be reasonably estimated and the probability of occurrence is probable, that means if we are likely to lose the lawsuit, and we can estimate the amount if we lose the lawsuit, we should record that as a liability. You can record it under the account called contingent liability. this account will be reported under the liability section of the balance sheet. If we are not that sure, which means it's reasonably possible, and we can estimate the amount, then we will disclose that in the footnote of the financial statement. If the likelihood is very small, which we call remote, and although we could estimate the amount, we don't have to report those liabilities on our balance sheet or the footnote. Rather, if the amount cannot be reasonably estimated, and when the likelihood is probable or reasonably possible, we are going to disclose them in the footnotes because we can't reasonably estimate the amount. If the likelihood is remote, then we don't really need to disclose. So you see, it's all depending on how probable it is and whether we could estimate the amount. So how often or how likely is the litigation contingency? In the US, litigation contingencies are very common. The average cost for the lawsuit is $2 million. The settlement is $1.7 million on average for firms. 2% of firms who were sued were lost, and 32% settled. This is from a paper from 2018. If you look at a particular case of Walmart, how often are they sued? They are sued at about once every 2 hours. But Walmart is one of the few companies who basically fight back. If we look at their footnote disclosure of the contingencies, you will see Walmart actually in the footnotes disclose the legal proceedings as the company is involved in a number of legal proceedings. The company has made accruals, which means they calculate or accrue the liabilities. They have made accruals with respect to these matters where appropriate, which are reflected in the company's consolidated financial statements, which means it's either on the balance sheet or it's in the footnote, depending on the occurrence likelihood and the amount being estimated. All right, so this concludes chapter 9, and I'll see you in the next chapter.